You've probably seen it 100 times without realizing. The price reverses, makes a quick pause, then takes off. That pause, that's the first pullback, and it might be the cleanest, most consistent entry you'll find on any chart. So today, we're going to break it down. In this video, you'll learn exactly what the first pullback is, why it gives you a better entry than chasing trends at the top, and how to combine it with supply and demand zones or Fibonacci levels to get tighter stops and bigger wins. You'll also see real examples so you can spot it yourself in any market on any time frame. Let's get into it. So what exactly is the first pullback? It's a highly reliable pattern that appears in almost every trade setup. Here's how it works. Imagine the price is in a downtrend and begins to reverse into an uptrend. As you probably know, clean V-shaped reversals are extremely rare when trends shift. What usually happens is the price begins to reverse, pauses with a brief pullback, and then continues climbing. This initial pullback after the reversal is what we call the first pullback. And I'm not exaggerating when I say this pattern shows up everywhere on the chart. Still skeptical? Let's go through a few examples. Here's a 4-hour chart of Bitcoin. The price was trending down, then reversed to the upside. Before moving higher, it made a small pullback, a textbook example of the first pullback. Now take a look at this gold chart. In this case, the price started in an uptrend, then began reversing downward. But before continuing the drop, it made a slight pullback. Again, the same pattern. Here's a chart of Apple stock. The price was initially trending down, then reversed upward, formed a pullback, and resumed the uptrend. You'll find endless examples like these on nearly any chart. Try spotting them yourself after watching this video. So the core idea behind this strategy is to time that first pullback and look to enter near its end. And the reason why it works comes down to one key factor: risk to reward ratio. Let's break that down with an example. Suppose you see a setup where the price is coming out of a downtrend and strong buying pressure starts pushing it upward. As a trend trader, you might recognize the shift and consider buying in. Quit jumping in right at the highs of the move isn't the best play. Why? Because there's always a chance the price pulls back, or worse, the new uptrend fails completely. If you enter at the highs with a tight stop loss, the pullback alone can stop you out. And if you set a wider stop loss to account for the pullback, you'll end up with a much bigger loss if the trend fails altogether. This is exactly why waiting and entering at the first pullback is almost always the better play. At a pullback, you're getting in the trade at a more favorable price, which means your stop loss can be tighter. If the price keeps dropping after the pullback, that's a signal that the uptrend is invalid anyway. So having a tight stop loss keeps your losses small. But if the trend holds and price pushes higher, you're set to make bigger profits since you've entered in at a lower price. It's a win-win condition. You'll get smaller losses on failed trades and much higher gains on successful ones. Now, let's break down how to trade this strategy step by step. The first step of trading the strategy is knowing how to identify a trend reversal. This part is absolutely crucial. If you mess this up, the trade simply won't work. Here's how to do it. One of the first things traders learn is how to recognize uptrends and downtrends. When price forms higher highs and higher lows, it's considered an uptrend. When it forms lower highs and lower lows, it's a downtrend. Sounds straightforward, but is it really that simple in practice? But here's the catch. There's a good chance you might be interpreting this wrong. Let me walk you through an example to explain. Imagine a chart that's clearly showing an uptrend, higher highs and higher lows. Then something interesting happens. The price starts to drop and breaks a previous low. This is where I see most traders make a common mistake. When that low gets broken, many assume the trend is reversed and believe we're now in a downtrend. But what if I told you this chart is still technically bullish? Yes, the price did break a low, but it wasn't a valid low. Why not? Because that low never led to a break of the previous highs. Let me make this absolutely clear. For a low to be considered valid, it must be followed by a breakout above the previous high. In our example, the price never actually broke that previous high, which means that low wasn't valid. The valid low is this one. So even if the price pulls back into this area, as long as it stays above the valid low, the uptrend is still intact. Now, let's take this a step further. If the price instead pushes higher and breaks the previous highs, that move establishes a new high. In this case, the valid low shifts to the most recent low formed just before that breakout. And from this point on, for the trend to reverse, the price must break below this new valid low. Let's walk through a real chart example. We can see the price forming higher highs and higher lows. The valid low in this case is clearly this one, because it led to a break of the previous high. Later, the price pulls back and eventually breaks that valid low. This confirms the trend reversal, since the price closes below the valid low. Just remember, it's essential to wait for a candle to close below the valid low. That close is what confirms the reversal, not just a quick wick below it. Once you understand how to properly identify a valid reversal, you're ready for the next step, entering at the first pullback. When you're planning to enter on a first pullback, the key is knowing where that pullback is likely to form. Pullbacks can happen anywhere, so pinpointing the right area is crucial to getting a high-quality entry. In my experience, there's one type of zone where the first pullback often forms and reacts from, and that's called a supply or demand level. For those unfamiliar, supply and demand levels are areas on the chart where large buyers or sellers have previously placed trades. The core idea is simple. If the price retraces back into one of these levels, there's a strong chance it will bounce, similar to how traditional support and resistance levels behave. So if we can identify these zones, we can better anticipate where the first pullback might form. The easiest way to spot supply and demand zones is by looking at the price area just before a sharp move. For instance, if the price surges upward, the base of that move is considered a demand level. If the price drops sharply, the area just before that fall becomes a supply level. Going back to our earlier example, you can identify this strong downward move to define the supply zone. Highlight the final candle before the drop occurred, this one right here. Then use a rectangle tool to draw the zone from that candle's high to its low. This forms your supply zone. Once you've mapped out a supply zone, you can place a sell order near the bottom of the zone. Set your stop loss slightly above the top, and aim for a take profit that's twice the size of your stop. As another option, you can target the previous swing lows as your profit objective. Now let me clarify something. With this strategy, you're not entering the market at the current price. Instead, you're placing a limit order at your ideal entry point, along with a defined stop loss and take profit. Once that's set, step back and let the market do the work. Your trade is only triggered if the first pullback forms and price returns to your entry level. Like in this example, price retraces, hits our sell order, then bounces off the supply zone, resulting in a solid profit. But keep in mind, there will be times when the price continues without ever touching your entry, and that's completely fine. If no trade is triggered, there's no risk and no money lost. The key is to stick only to trades that align perfectly with your setup. If it doesn't match your plan, don't force it. Stay patient and wait for the next clean opportunity. Let's go through another example. Again, the first step is to identify a trend reversal. In this setup, the price was in a downtrend and started climbing. But here's the twist. This move didn't form any clear lower highs or lower lows. It was a single, sharp swing. So how do we confirm this upward move as a valid reversal without obvious highs or lows? This is where trend indicators become useful. While there are many to choose from, I prefer the MACD for its simplicity and reliability. So let's bring it into this setup. Once we apply the MACD, we can check for confirmation that the move is a true reversal. In this case, we see a bullish cross right here. That's our signal, confirming that the trend has shifted upward and we're now in an uptrend. So now we can move on to the next step, which is entering at the first pullback. To do that, we need to identify a demand level within this setup. In this case, we can see that the impulsive move upward started here, so the first candle before that surge becomes our demand zone. The next step is to place a buy order near the high of that demand area. Set your stop loss just below the zone and use the most recent high as your take profit target. Once that's done, we simply wait for price to follow the trading plan. In this example, the price pulls back, triggers our buy order, and then continues upward to hit our take profit. Now, even though this trade ended up working out, you'll notice that price experienced a slight drawdown. It came very close to our stop loss. But because we trusted the plan and allowed the trade to play out, price eventually bounced and hit our target. This reinforces why sticking to your original trading plan is so important. Even with some drawdown, staying disciplined and letting the trade unfold can still lead to a win. That brings us to a key question. What if you can't clearly identify supply and demand zones on the chart? Well, there's another technique I use to enter pullbacks without relying on those levels, and that's Fibonacci retracement zones. This tool automatically highlights key levels based on Fibonacci ratios. As you'll see, it generates several horizontal lines where price might react. But one level in particular, the 61.8% retracement, also called the golden zone, is where price most often pulls back. That makes it the most reliable level to watch. Some traders go even further and use Fibonacci levels not only for entries, but also to define their exits. In the clip below, Dated Paul shares how he applies Fibonacci logic across both sides of a trade, especially in structured patterns like wedges and Gartleys.
What the favorite exit method, again, for me, it would be Fibonacci orientated. On the falling wedge stroke 3 drives pattern, I have a exit criteria based on geometry, which is proprietary to me, which seems to work, and I've been using it for a very long time. On the Gartley formations, then I want to get in at that 61% pullback after the 3 legs back, and then I want to add to the position, and then I'm looking for an expansion to 1.618 of the entire pullback for an exit criteria, and that has worked very well. Some of them just fly. For example, that copper trade I talked about just kept on going for weeks and weeks and weeks and ignored all the Fibonacci levels.
While David uses Fibonacci in advanced patterns and includes position scaling and extended targets like the 1.618, our application is simpler and more mechanical. We focus on the first pullback, a clean 61.8% entry, and well-defined stop loss and take profit levels. A tighter setup with fewer variables, ideal for consistency. Here's how I apply it. Once I identify a potential first pullback setup, I use the Fibonacci tool by dragging from the swing low to the swing high. At the 61.8% level, the golden zone, I place a buy order, set my stop loss just below it, and for take profit, I either aim for the previous high or even higher, since these setups often lead to extended runs. Once the setup is in place, I let the market do its job. In this example, the price barely taps our entry before bouncing from the golden zone, and the trade hits take profit cleanly. Now here's the exciting part. The first pullback isn't just a standalone strategy. It also works as a powerful add-on to the strategies you're already using. Take the breakout strategy, for instance. It pairs perfectly with the first pullback. I won't go too deep into breakouts here, but the core idea is simple. Price consolidates, then breaks out sharply, often moving too fast to catch. And if you chase the breakout and enter late, you'll usually end up with a weak risk to reward setup. That's why I prefer to wait for a pullback after the breakout before jumping in. Once the breakout occurs and momentum starts to cool off, I apply the Fibonacci tool again, from the bottom to the top of the breakout move. Then I set a buy order at the 61.8% level, place my stop loss just below, and target the previous highs for take profit. Then I let it run, and in this case, price retraces into the golden zone, tags our entry, and bounces. Another smooth win right off the first pullback. Now, I cannot stress this enough. Sometimes the price won't pull back. It'll just keep running, leaving your order behind. And yes, you will miss a few trade opportunities using this strategy. But missing a trade is not the same as losing one. Personally, I'd rather miss a setup than chase a bad entry with poor risk to reward. The goal isn't to be in every trade, it's to be in the right ones. And to stay consistent with that, you need more than a strategy. You need structure. You need process. And above all, you need focus. That's exactly what professional traders prioritize every day. And nobody explains it better than Linda Raschke, legendary trader and market veteran. Listen to how she prepares, manages energy, and creates the environment to perform at her best every single morning.
Well, first of all, I always try to have my homework done the night before, my plan the night before, and then, of course, first thing I'll do when I get up is usually check the markets just to see where they're trading so I can get a baseline reading. Two things. First of all the opportunity comes in the morning sessions, and you know, I usually start at 6 a.m. Central Time. So 7 a.m. Central Time is a big pickup in activity in the market. So if I'm watching it a little bit beforehand, it helps get a feel. Also, when you're trading, it's a performance-oriented discipline. So the more you can eliminate distractions and get yourself into a ritual or groove right away, I think you're better able to concentrate. And that's really the key, is being able to concentrate right off the bat. And the more you can do something consistently the same way, the easier it is to slip into that zone, if you will. So for me, it's always important that I eat a big breakfast. I always have a giant bowl of oatmeal or a couple eggs, and you know, that really only takes 5 minutes. But you got to fuel the body and got to fuel the brain. That's so important. People sit there and think they're going to make it on a bagel or something, and it just doesn't work that way. So it's really important to have some good nutrition, and just make sure you're in a calm space. You've got your stuff around you, your trade sheet or your game plan, and just not try to think about too much of anything. You know, you don't want to go so crazy drinking coffee or something. You're going to have to run to the bathroom right after the opening bell, you know. So I think it's everybody kind of finds their own routine for themselves. But do eat a good breakfast. Do have your homework done the night before. Try and have a space where you're not going to be distracted, or kids knocking on the door, or phones ringing, or that type of stuff.
It's not about reacting to every move. It's about showing up prepared, staying focused, and executing only when the setup is right. Exactly like we've covered in this video. And that's exactly the mission of ComLucro. Our goal is to give traders the knowledge they need to make better decisions in the market. Every video, every course, and every piece of content we share is built with that in mind. Clear, practical information that helps you grow step by step as a trader. On this channel, you'll also find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading is not just about the charts, it's also about how you think and how you manage risk. We also bring lessons and insights from world-class traders and coaches like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others who have shaped the way we understand the markets. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube.